Hello, I'm Mark Burgess. I'm chairman of ONFIF in Asia. I'd like to welcome you all to our roundtable on Asian economics today. We've got an absolutely fantastic lineup of panelists. And I'll just quickly introduce our panel. Shikahisa Sumi is the regional office for Asia and Pacific, and he's director of the IMF. Margaret Molar is the head of the China desk of the economics department of the OECD. Zeno Ronald Abanoa is the managing director of the Department of Economic Research at the Central Bank of the Philippines. Dwight Evans is the managing director, head of APAC macro strategy at State Street Global Markets. And Dennis Sheen is the director of sovereign and public sector research at Scope Ratings. I'd like to welcome you all to today's discussion on Asia. In fact, just prior to our conversation here, we had a little group get together and we're talking about what a great benefit it is, at least having the ability to talk through Zoom to a whole bunch of colleagues around the world. And I think particularly at a time when Asia is so critical to future global economic growth. I think it goes without saying, and I'm sure there'd be very few that would disagree with this, that if Asia doesn't grow or Asia doesn't come together in reasonable growth profile over the next decade, the world itself may not grow particularly well. And so the damage or the changes that have occurred here during the COVID period is absolutely critical that we understand where Asia's at. And I think this applies to all of our global investors and all of our global members, but also obviously applies to all of us here in Asia. So we've got a great panel tonight today that will set up the discussion on the Asian economy. And we very much welcome questions later on. Once the panel have completed, each panelist will talk for about 3 to 5 minutes on their area, but we'd strongly encourage you to please ask questions. And that'll allow us to channel debate and discussion into the areas that I'm sure are of great interest. Just the final thing I'd say, of course, and everyone's well aware of this, Asia is not uniform. Asia's many countries. And so there may, for example, be a question in an area that you'd like us to focus on. And so please help direct us so that we get the kind of debate in the next hour that adds a lot of value to yourself. So I'll hand over to our first speaker, Mr. Sumi of the IMF. Thank you very much for your views and opinions. Thank you.
Well, thank you very much. In the next 5 minutes or so, let me share our economic outlook on the world and Asia based on our October 21 World Economic Outlook. Next page, please. So this is an overview of what I'll be speaking. Now, the fault lines appeared by the pandemic between the faster recovering countries and then the rest of the world pretty much comprising of emerging markets and developing countries which are slow to recover. And then that the vaccine inequalities and then policy shifts, near-term divergences is likely to become medium-term scarring. And then for those countries that's recovering well, the employment is lagging, the activity recovering. That has some policy implications. And also the increased uncertainty about the path of the pandemic. By the time of writing, we didn't know about Omicrons, but these are new variants. There's only probability, but that's now with us, and then that casts doubts about how quickly we get over this. And then policy choices becoming more difficult because the inflation is rising, while that employment is not still up to the speed. So that's that makes the monetary authorities the very difficult choices, and then especially in the U.S., their monetary action has a big implications to the rest of the world. And then, that the COVID masks all, but before the COVID, we had we had big challenges, climate changes, and then also geopolitical tensions and all. And then that trade is the freer trade is seems to be somewhat at risk. Now the risks, of course, are tilted very much to the downside. With the variants coming, and which we don't know how serious it gets to be. So this is the very serious concern. And then we see the supply-demand mismatches, and then they likely not so smooth functioning of global value chain, so which has benefited in great deal especially in the Asian region for allowing the region to grow very fast. Next slide, please. Okay, so the left-hand side panel shows the confirmed COVID deaths. So the only point I would like to make out of this chart is that how unsynchronized we are as the severity of the disease. So in this around June, we had a big surge in India, and then toward the August, September, we see the big surge in the rest of Asia. So the world is seeing waves of these new infections and deaths. Depending upon the time, the focal points shifts. And then also to the right, you see the big vaccine inequity. Next slide, please. So this is our October forecast, and then we envisage the world to recover 5.9% and 22 4.9%. And the Asia is still envisaged to be the fastest growing region. And then we have the country data on our website. So if you're interested in the country specific data, please do visit us on our website, which has the bulk of the information. Next slide, please. The important thing I would like to draw your attention is that scarring. You see, this blue line is advanced economy, and then red line is the emerging markets and developing economies, except for China, and green is China. And the dotted line here is the pre-pandemic baseline. We envisaged before the pandemic took place, we thought that the economy would grow like according to this dotted line. And then in reality, now we are envisaging this solid line. You see, for the advanced economies, you notice that somewhere before the 22, we see that the new projection is overtaking the old, meaning that the economy will be doing better than we had envisaged before the pandemic for the advanced economies. And then for China, it's somehow it's not growing back to what we had envisaged, but still the damage is not that big. But look at this big discrepancy for the emerging market and developing economies, except for excluding China. So they have been hard hit, and then even though they are recovering, their recovery is nowhere near catching up with their pre-pandemic path. And then looking at the region by region, you see that emerging Asia, excluding China, has suffered the biggest loss. This is a cumulative output loss. In a sense, this is the square inch of this, the differences up to 24. But the emerging Asia and the China, excluding China, is the biggest hit. And China is also hit by about 3%, but the emerging Asia and excluding China is hit by 9%, which is by far the largest. There are some, I think that the reason is that before the pandemic, this region has been the fastest growing. And then this region has benefited greatly from the smooth functioning of global value chain, which is now being at risk of because of the high freight costs, and then that backups at ports elsewhere. Okay. On the contrary, the U.S. has recovered, and then that's doing much better than what we had envisaged before the pandemic. Next slide, please. And then last thing I would like to say is that look at this portfolio flow. This is the gray line to the right of your right panel, shows that the cumulative money, portfolio flow to the region, which shows that the big drop in the earlier part of the 2020, when that's recovering. However, please note that except for China, which is growing, and the India, which has recovered, the portfolio flow to the rest of Asia is still declining after so many months into the pandemic. So it's a stark contrast to the global financial crisis, aftermath of the global financial crisis, where the Asia attracted so much of the portfolio flow, being considered the safe destination, and then that hunting ground for the hunt for the yields. So this has a big policy implications for the external sector management of the economy. I stop here. Thank you very much.
Thank you very much, Mr. Sumi. And as the audience will know, that's covering a lot of ground. So I'm sure there's going to be a lot of questions, perhaps drilling into a particular country or area. I now hand over to Ms. Molnar, who's the head of the China desk at OECD. Thank you very much.
Good morning, good afternoon, or good evening, everyone. As Mark has said at the beginning, Asia is indeed very important for global growth. China in particular, and in particular during COVID times. During 2020, China contributed more than 1/3 of global growth. And this is much higher than it used to contribute before COVID-19, which was about 27-28%. So China's recovery, which happened as early as in the third quarter of 2020, is very important for the whole world. It was, by the way, one of the earliest recoverers among all countries. And the recovery was driven by investment. This means that the rebalancing from investment to consumption, which has already started before the pandemic, has temporarily stalled. And this is still a question whether this rebalancing will continue again and when. Our forecasts, which were published last week in our economic outlook, say that for this year, it will be around 8.1%. Next year and 2023, 5.1%. And these, there will be a couple of trends, global trends, as well as domestic changes and structural trends that will shape this outlook. There are in particular two important global trends that will make an impact here. One is COVID, as the previous speaker already mentioned, that will be a very important determinant of the outlook for next year. And the other one is climate targets, decarbonization, which is going on. So let me drive you through how these two trends will affect China's outlook for the next couple of years. First of all, starting with COVID-19. COVID-19 obviously will have an impact on trade, and it has already had an impact on trade. And in particular for China, because it has completely reshaped how trade accounts look. Before the pandemic, China's trade was mainly driven by goods surplus and services deficit. And the services deficit, which was mainly related to tourism imports, that is Chinese tourists' consumption abroad, that almost equal to the size of goods surplus. So because of this, the current account surplus was reduced year by year before the pandemic. But it is still to see whether this trend will come back, as the pandemic completely changed trade relations. It increased exports and it decreased services imports, that's because of the pandemic-related restrictions. And it is still to see whether these very high exports, which almost looking like starting a new trend, will continue in the long run. That is because, first of all, these exports were driven by COVID-related goods, which we already see this year. They have already started to decrease. And the other is some durables, such as teleworking-related goods. It's still to see how long this can support export growth. So it's still a question about to what extent trade will provide a support to growth, at least in the magnitude that it is providing currently. COVID-19, this global evolution of the pandemic, will also have an impact on consumption. And it has also so far had a very big impact on consumption, especially of services consumption. However, I think that the relatively slow recovery of consumption in China is more related to structural factors than just the pandemic. For instance, an example is that domestic flights, especially passenger flights, have already recovered in the third quarter of 2020 to pre-pandemic levels. So it definitely does have an impact on consumption, but probably more importantly, consumption is determined by household incomes. And household incomes grew at a very low rate in 2020, at even a lower rate than in real terms than GDP. And that was an impact of very low consumption as well. Although consumption recovered or is recovering this year, but to increase consumption in the long term, it is very important also to improve social protection. In particular, unified pension system. This is what we have seen in the Politburo meeting summary that was held last week. And also to improve basic public services. This was also mentioned. So these are all trends that are indicating an improvement of social protection, which will be crucial for the increase of consumption. Not to mention that in China, the single major reason for poverty, for falling into poverty, is health expenses. So to improve health insurance as well as pensions, it's crucial to increase consumption in the long run. Now turning to the other global trend, which is climate targets. Climate targets will clearly have an important impact on investment in China. Even though by several measures, infrastructure investment has already reached the level of that in OECD countries. Nevertheless, there are still some areas where there is a huge need for infrastructure investment, and one of those is renewables. But there is also environmental services or underground structures or urban transit systems. There's also still a big need for infrastructure investment in those areas. And infrastructure investment will also be shaped by some domestic structural changes. That is, for instance, the local government investment vehicles, which used to be the major deliverers of local urban infrastructure, now are changing their business model. So they are becoming more market-oriented. They are more focusing on land and real estate development. And now they are only allowed to deliver services for the government if there is a budget secured for those infrastructure projects. So this means that infrastructure will be more delivered by the government, and that will also help reducing the excessive leverage of these local government investment vehicles. And it is still to see whether this infrastructure investment, which is foreseen to pick up, especially given the climate targets, whether and to what extent it can replace the fading real estate investment, which is related to the credit events that we have seen during the past months, or even during the past year, or even a little bit longer than a year. But in any case, stability will be the major keyword for the coming year or so. And for stability, there will need to be a couple of structural changes, structural reforms to adopt it. One of those reforms will be the social security reforms, which will be crucial to move growth back to the sustainable level, which is rebalancing towards consumption from investment and also rebalancing towards services from manufacturing. Thank you.
Thank you very much. You can always tell by how stimulating the conversation is by the range of questions we're already receiving. So thank you to our first two speakers. Our next speaker, we're very fortunate to have a central banker, and not just from any country, but from the Philippines, which, as our audience would know, is one of the three strong demographic countries in the region, Indonesia, Philippines, and India, that will be very, very crucial to future growth in the region. So I'd like to hand over to Mr. Zeno Abenoya to give his perspective on the current situation. Thank you very much.
Yeah, thank you, Mark, and good day to the participants in this afternoon's session, at least afternoon from Asia. Yeah, so again, I would like to thank OMFI for inviting BSP to join this panel. Let me just provide a quick update on what is happening in the Philippines. After 5 consecutive quarters of contraction in GDP since the first quarter of 2020, we have seen the Philippine economy appearing to have turned the corner. GDP grew by 12% second quarter of this year, and that was followed by 7.1% growth in GDP by the third quarter. And the economy was able to sustain this growth even as there were some stringent containment measures that were implemented during the third quarter of this year. Now, given those 2 quarter performances, our GDP growth is now at almost 5%, and that is at the upper end of the growth target for this year. So we are looking at the possibility of growth rate exceeding 5% for this year, and for next year, even growing at a faster clip of about more than 7%. Now, even as the economy begins this to show nascent recovery, the output gap remains to be in negative territory. So this is something that we are looking at very closely. We think that the economy will probably go back to 2019 levels, the size of the economy, by about middle of next year. Now, in terms of inflation, we expect inflation to settle above the target this year. The target range is 3 up to 4%. And right now we are about, probably for the year, we will be at about 4.4, 4.5% average. So that is above the target. But if we look at recent numbers, it's going down, and we think that by December, we will be within the target range. And for next year, we will be near the midpoint of the same target range in terms of inflation. Now, what has been driving inflation in the Philippines? With inflation higher than the target range so far this year, it's mostly because of the impact of the African swine fever on meat prices. It's the impact of high international crude oil prices and adverse weather conditions. So what we're saying is that these are mainly supply side shocks, given that the output gap remains in the negative. But if we look at inflation expectations, they continue to show anchored expectations, especially if we look at next year and in 2023. For the BSP, we think that inflation will average about 3.3% next year and 3.2% in 2023. And the inflation expectations right now are within those range, in the middle, near the middle of the target band. Now, that is important for monetary policy. While we see that the recovery is getting stronger, but we still have a negative output gap, but inflation remains well anchored, then that provided room for monetary policy to remain accommodative so far, remain accommodative this year. So we have maintained monetary policy settings for the most, since the beginning, since the time we reduced aggressively the headline policy rates. And we also maintain the liquidity enhancing measures, like reducing the reserve requirements and providing provisional advances to the national government. And of course, some asset purchases also in the government securities market. In terms of the external sector, we continue to enjoy surplus in the balance of payments. Chikahisa mentioned earlier the important role of foreign portfolio investments. So that is something that we are also looking at very closely. But if we look at the external profile of the Philippines, it's the remittances, it's the business process outsourcing revenues that are a structural flows, a steady source of FX flow that supports the balance of payments. In fact, we have seen also foreign direct investments continue to grow since the last 1.5 or almost 2 years now. And that has helped us continue to have adequate buffers, particularly international reserves are about 11 months worth of import cover right now. So that could help us if there are any further external shocks moving forward. Now, in terms of the policy moving forward, the central bank recognizes the central role of fiscal in this recovery process. Again, there are some concerns about scarring effects, but the fiscal authorities, we think, are in a position to address these possible concerns. At the same time, as the economy heads towards the recovery, when conditions warrant, the eventual process of normalization of BSP's extraordinary measures and monetary policy settings will be outcome-based rather than anchored on a particular date. Consistent with this approach, we will be guided by the outturns in economic data, including inflation, inflation expectations, employment conditions, real sector activity, liquidity, and the return of more robust credit growth. So going forward, the BSP will continue to ensure that the setting of policy, the expansion of money and credit, along with fiscal stimulus, will not lead to excessive inflation and also lead to some vulnerability in terms of financial stability risk. I stop here, Mark, and we look forward to more discussions later. Thank you.
Thank you very much for the excellent summary and particularly insights, I think, to the Philippines, so crucial to the region, as I was saying. And now I'd like to introduce Mr. Dwight Evans, who is probably very well known to you all, Managing Director and Head of APAC Macro Strategy at State Street Global Advisors. Just to put some pressure on you, State Street does great work, so I'm very much looking forward to the comments. Thanks very much.
Thank you, Mark, and thank you, everyone. It's a pleasure to attend. I'll keep my comments quite brief, actually, only because a lot of material has been touched on already. There's not much value in reiterating what's already been said, and certainly some of the comments that have been made by Sumi-san and also by Margaret on China and on capital flows is something that I was going to touch on, but I will look at it in a slightly different direction, in a slightly different angle. As some of you, many of you know, State Street is one of the world's largest custodians. And one of our sort of key proprietary research metrics at State Street is to understand capital flows via the custody data that we collect or that we custody for as part of our role as a custodian. And we do this to better understand overall risk sentiment, asset class preferences, preferred countries and regions, positioning underweights and overweights in various financial markets, positioning unwinds, and so on and so forth. So my quite short prepared comments for today will be skewed towards understanding what we're seeing in terms of capital flow trends and market trends, also within Asia, particularly maybe emerging Asia. And it's a natural follow-on from the comments that was made a few minutes ago on portfolio flows from Sumi-san. So when we track capital flows, as we continue to do over the last 20 years, the clear signal that's come post-COVID, if we can call it post-COVID, but certainly post the first bout of COVID at the beginning of last year, the clear trends that we see is that risk appetite has been very strongly supported by the very rapid policy adjustments that we saw in Q1 and Q2 last year, whether it was monetary policy or whether it was fiscal policy. What we've basically seen for the most part over the subsequent sort of 18 months or so is very strong buying of risk assets. Now, you would think that if we see very strong buying of risk assets, this would include emerging markets, it would include emerging Asia. But interestingly enough, investor sentiment towards emerging markets and emerging Asian assets, I should say, has actually been weaker than what we would have otherwise expected. And part of this is performance related. When we look at total dollar returns across Asian currencies, Asian equities, Asian local currency sovereign bonds, they're barely above their level at the beginning of the year. So despite all the talk about liquidity driven markets, despite all the talk about reflation, and despite all the talk about strong risk markets, the bottom line is that Asian markets this year have not performed particularly well. So reflation, I guess, has been very supportive across very selective assets, developed market assets, US equities, for example, alternatives, crypto, real estate. We know these assets have done extremely well with the very abundant liquidity environment that we've had over the last 18 months. It's not been all that supportive for Asian assets, though, and I think this is pretty much in line with the comments that Sumi-san made earlier. So if we dig a little bit deeper into that narrative, there is a very notable divergence between the aggregate regional flows that we see into Asia and that very same aggregate that excludes China across both equities and debt. In other words, the very strong capital flows that we've seen into Asia in 2021 have been very strongly driven by flows into China, particularly into Chinese debt. To a lesser extent equities, but really Chinese debt has really been the key driver of flows into Asian markets this year. And one key reason for that, and this is something that I think goes beyond China, but one of the key reasons for that is that real policy rates across the vast majority of emerging markets remain in negative territory. China is one of the very, very few exceptions, and this makes the bond market in China very, very attractive on an absolute and relative basis. Now, there's one other market, and it's Asia-based. There's one other market where real rates are positive, and that's Indonesia. And the discussions certainly that we've been having with real money investors and investors more generally in recent months actually point out that Indonesia could be one market to watch very closely in 2022, given Indonesia's shift back towards its current account surplus environment, which is something we haven't seen for a very long time in Indonesia, but also this real rate environment. And when we think about markets that may outperform in 2022, there does again seem to be a shift towards those markets where you get a proper, real positive return on rates. China and Indonesia are two in the emerging market space that stand out in that regard. On growth, because this is another very important factor in terms of attracting capital flows into the region. On growth, I think the biggest difference for us is that in 2022, we are actually expecting a revival of growth and sentiment into South Asia. So we acknowledge some of the headwinds for North Asia. These have been touched on already, and the continuation of the pressures on the housing sector for us is something that's going to be front and center of the Chinese policy stance for the next year and beyond. We actually think that South Asia will do very well relative to other global regions in the emerging markets. Reason for that is that in other emerging markets, rate hikes will exert a cost on growth. When you think about the rate hikes in places like Brazil, Mexico, Russia, South Africa, when you think about the significant negative real rates in places like Central Europe, Poland, Hungary, and the Czech Republic, actually the positive real rate environment, and also and this is an important point, also in South Asia, the fact that the likes of Indonesia and India and Thailand have kept inflation at a very, very low level has added an element of credibility to policymakers in the region that maybe hasn't been there consistently in the past. And I think that will be a positive for investors as we go through 2022. The big risk, of course, for South Asia is the travel and tourism sector, which is basically 15 to 25% of the economy in these markets. That's the big risk. If this COVID variant and other variants, dare I say, beyond, exert a downside risk or a downside cost to tourism, clearly South Asia will not be immune to that. One thing on China, and China's been covered extensively, so I won't spend very long on this, but one thing on China, we at State Street have developed a macro momentum indicator. It includes the usual indicators. It's a combination of credit growth, PMIs, other leading indicators, etc. That actually dipped into negative territory in the last quarter, and we haven't seen it there for a very long time. So not a surprise to us that the policymakers have now seen fit to move back towards extending credit again through the RRR. This is something that we would expect again in 2022 will be a continuation of policy in China, although there's not necessarily that quantitative target anymore as far as growth. 2022 becomes a very important country for China, of course, because of the People's Congress meeting at the back end of next year. Growth will have to be supported. So again, I think that probably speaks of probably an out of consensus stronger growth profile for China than some of the pessimists have argued in the second half of this year. But it also means as well that policy adjustment, we think, is going to be an ongoing process for China as we go through the beginning of next year. And that should cascade down to the rest of the region as well. So I guess I'm going to leave it like that. But the argument, I guess, for me is that despite all the positivity around Asia, when we track capital flows into the region, they have been somewhat sort of disappointing given the whole liquidity and reflation environment that has supported risk assets elsewhere in the world. And I'll leave it like that.
Thanks, Francis Dwight. Well, we do have a number of questions on China coming through, so we are going to circle back to it, particularly in relation to China itself, but also its influence on the region. And just to give the panel a little heads up, I'm going to ask you about what scarring has occurred during COVID, what policies perhaps need to be adjusted looking forward. I know this has been touched on, but I'll ask each of the panelists for some of the areas that they'd like to see, say, policy or issues or scars that need to be resolved to help growth come forward. So just a quick summary will be the next. But I'd like to introduce Dennis Shan from Scope. I'll hand over to yourself, Dennis. Thanks very much.
Thank you, Mark, and much obliged. Indeed, we at Scope, we published our 2022 Global Economic Outlook on Tuesday this week. In the Outlook, we outline the expectation for continuation of our longer standing baseline, which is for an uneven but robust global rebound, with the unevenness of global recovery naturally relating to the ebbs and flows of the COVID-19 crisis and how it impacts different countries differently. With emerging economies naturally having the most significant vulnerabilities with the lowest access to vaccine. But looking longer term, I think it's important to reference that the severity of virus risk for the global economy is continuing to moderate gradually, but moderate over time. That has to do with many things, but among them, that as governments adapt in terms of their responses, as COVID-19 itself becomes more transmissible, but less lethal, and as businesses and people adapt ways of doing business during lockdowns. We anticipate above potential calendar year growth, 4.5 globally in 2022. That's after 5.8 this year. Global trend growth, we estimate of around 3. And so 4.5 next year is well above trend. Slowdown in China is part of this normalization trend in the rate of global growth from 2021 into 2022 to 5.2% in China in 2022, after around 8% this year. Normalization as well in other country domiciles in the same direction, moving in the direction of trend. Euro area 4.4 compared with 5.0 this year. US 3.5, 5.5 this year. Japan bucking this trend and improving in 2022, 3.6 compared with 1.5 this year, supported by significant budget stimulus. And so entering 2022, we see China as remaining the main engine of global growth, even with the slowdown, contributing or accounting for over 20% of global growth in 2022. In addition to COVID, a big theme remains inflation. In that respect, we were early in this global inflation debate in indicating that there is a moderate structural component to current high inflation, and that many views from global central banks, so as an example, about inflation being transitory and this and that, that there is a degree of continuing underappraisal of the degree of risk from inflation. And with higher inflation comes a degree of divergence in the magnitude of inflation risk between different national domiciles, and that results in this current monetary policy divergence we are seeing, which we see continuing well into 2022.
Thank you very much. We're getting so many questions. I'm going to delay my one just for a moment and go straight to the first set that we've received, actually. So the first obviously is about the situation in China, and Margaret has given us a really good insight there. But I'd like the panel perhaps to either give a reflection on the influence of China's economic growth profile and how that's affecting your perception of how the region will respond to the influence of China's changing profile. And that also obviously opens up your own thinking on the profile. And for Margaret, for you, I know you've touched on this already, but we've had a number of questions about the property sector, as you'd expect, and perhaps you might want to just fill in a bit further on your sense that there. But perhaps I'll ask Mr. Sumi first about the influence of China, its growth profile, and how you're thinking about that as you come up with the forecasts across the region and its effects. Thanks.
Thank you, Mark. You know, the Asia region has generated about 2/3 of the growth momentum prior to the COVID, right? And then large part of it is China. And then although it's not classified as China, that China has been in some part of the global value chain for most of the industrial production in the region. So its influence is so very, very large. And then, but now with the very strict COVID actions, and then also the electricity shortages, that has played a very important role in the somewhat restricted supply of goods to the rest of the world. And then with the, as I mentioned, that global value chain being not as smooth as they used to be, that of course it's not of course not only China, but the large part of it is the China, and then also we observe that the freight costs out of Asia to the rest of Asia has been skyrocketing, and then that's also contributing to the inflation elsewhere. So again, that I just stop the pointing that the China still, of course, the very important player in this all this, and then of course the any big surprise to the financial market originating from this you know, the solution of this issue about this Evergrande and the other real estate related sector has a very big impact on the rest of the world. But of course, we are quite confident that the Chinese authority has the ability and that to bring it to the orderly this, you know, the solution.
Thank you very much, Margaret. You did touch on this, but perhaps we've so many follow-up questions on property, just to perhaps re-emphasize your view there and how that will be managed here, or your kind of expectations.
Yes, thank you, Mark. As we have seen in recent government documents, the focus will be on stability. So how to orchestrate like a kind of a soft landing of the property market, that will be the major task in the coming months and probably over at least the first half of next year. The property sector is very important both for growth and also for fiscal revenues. The property sector contributed most of growth, both in 2020 and 2019, followed by infrastructure investment. So real estate investment was even a greater contributor than infrastructure investment. So obviously, if real estate investment shrinks, then that would hurt growth to a very large extent. That's why it's very important that defaults happen in an orderly manner, so that it will have a positive impact in a sense of improving risk pricing, which was already needed in the market to avoid taking excessive risks. So the property market, both in terms of like investment in property, both in property sales and also prices, have come down in recent months. But what is important is to avoid a disorderly winding down of the property debt. So deleveraging is going to continue. Property sector's contribution is going to shrink to growth, and also probably government revenues related to land rights sales will also temporarily shrink. But now, as briefly mentioned before, there is a kind of a structural change. So the local government investment vehicles that used to deliver infrastructure projects, now they are increasingly going into land development and real estate development. So if they can take over this function of these particular private real estate companies of developing land, because these private companies currently have a squeeze, a liquidity squeeze, and a problem with access to financing. So then this could ensure a smoother transition to a more sustainable path. Thank you.
I think without putting words in your mouth, and the markets appear to be believing this, that there's going to be a managed adjustment. But I think Mr. Sumi is also warning us that it needs to be on watch as well. I think that any surprise could cause an influence. Because we're getting a few questions, I might just...
Warning's a bit too strong, right? Mark,
a warning's a bit too strong. I'm sorry, that's correct. That is correct. So I might just ask Dwight for his view on the next question, which is really about policy adjustment. And I think before everyone's now fearful, or not fearful, but wondering about monetary environment, the US-driven monetary environment, and how that influences the region. But just before we sort of ask you that question, I think we should reflect on how well policy adjusted globally to what was a genuine shock last year, and you know, has really driven the global economy so much better than it could have. It could have been somewhat worse, of course. But Dwight, what's your sense for the monetary policy environment globally and its influence on Asia, and is Asia building enough resilience to sort of get underlying growth and get through this next period? Of obviously, there's a bunch of scenarios, so I don't want to put forecasts into that question. But what's your thinking? How do you think about the policy adjustment as we look forward?
So we've done some work on this. I mean, we could spend the whole hour on this, couldn't we? We've done some work on this to try to understand from a broader emerging market sense, not just from Asia, but we'll stick to Asia, given that is the topic of the day. The vulnerability to tightening from the Fed. We've done some work on this, and I spoke in glowing terms earlier about Indonesia, but interestingly enough, actually, when you look back historically, where is the most vulnerable bond market to Fed tightening? And it just happens to be the Indonesian market. And where is the least vulnerable market in Asia to Fed tightening? That just so happens to be the Philippines. So some of the back tests you can do on this are quite easy. I would probably argue that one of the there are many changes in Asia over recent years that I think has reduced Asian vulnerability to tightening of monetary policy globally. And this is actually crucial, because when you think about higher US rates, higher rates in places like the UK, for example, or higher rates in other developed markets, the direct impact of that, of course, is that it reduces capital flows to emerging markets into Asia. And therefore, it creates a vulnerability both on the current account, but it also creates a vulnerability for currencies. Currencies sell off with capital outflows. The sell-off in currencies triggers inflation. Inflation triggers higher rates, and higher rates stem curb growth, and lower growth means that you don't have equity flows coming to the region, and it becomes a vicious cycle. I actually think we've broken that. And I think we've broken that for a number of reasons. Firstly, because the resilience in Asian markets is partly built around the significant rebuild of reserves in the region, which should not be underestimated. Now, I think that's an important sort of structural change that we've seen in the region more generally. We've always had huge reserves in China and in Korea and in Taiwan, but actually South Asia has built reserves over the last few years, which are themselves a real buffer for the region. There is also this question as well of policy credibility, and there's also the issue of the current account. So policy credibility, I think, stems from central banks in the region that are now seen to be far, far more credible, I would argue, than central banks across much of the emerging world. And again, my comments are very much centered on emerging Asia here as opposed to developed Asia. But when we think about the taper tantrum of 2013, when we think about the vulnerability in particular of the so-called sort of fragile five, if we all recall, that particular theme of the day, as it were, incorporated within those fragile five were Indonesia and India. And when we talk about the potential normalization of monetary policy, in particular in the developed market world today, and if we look through in terms of forward rates, rate hikes and tapering is expected in this country and that country over the next 2 to 3 years, actually, we haven't really seen a fallout in Asia. We really haven't seen a proper fallout. Currencies are stable. Current accounts remain very, very well supported. And generally, financial markets in Asia have behaved very, very well. I would therefore argue that our core view right now is that if there is a bias anywhere in terms of global monetary policy, it could well be the case that central banks will have to walk back a little bit of what's actually priced in terms of tightening going forward. That's a very live and a very dynamic and fluid situation. But we actually think that it could well be the case that the bark is louder than the bite, or is more effective than the bite. For example, we don't necessarily see many of the G10 markets necessarily following through with much tighter policy. And if that's the case, the fallout in Asia will actually be much more subdued and much more benign. We actually think that Asia looks in a better position today to deal with the tightening of policy globally. But part of that is also a reflection of investors having reduced their exposure to Asia in recent years. So in other words, I would argue that some of the vulnerability of Asian markets we've already seen. If we look at the likes of Indonesia and Malaysia and some of the other markets that have been the recipients of very strong foreign inflows, particularly into the debt markets, positioning now by foreign investors in these debt markets is much lower than it was a couple of years ago. And that positioning change and adjustment has been made without necessarily creating a fallout in terms of local markets. Currencies are very stable. Current accounts are very stable. Financial markets within Asia tend to be very stable. I would actually argue that probably today, more than at any stage over the last 15, 20 years, Asia looks to be in a better place and less vulnerable against changes in global policy markets than it has been really at any stage, I would argue, post the GFC, even before the GFC. And that's a structural change. And that is a stronger fundamental backdrop to most of the markets in Asia. North Asia has always been structurally quite strong. South Asia has actually become structurally far stronger as well in the last sort of 4 or 5 years. And that's a very, very important way of isolating these countries from some of the fallouts on global policy.
If we don't give investment recommendations, but we do enable the debate. And I think your point earlier, which is about the surprisingly low inflows, and now perhaps the surprisingly resilient nature of Asia is a very critical combination, unlike so many other things which have inflows and everyone already knows how good they are. So it's a very, very important point. Perhaps just turning to the Philippines, if I could. We have received a question here about the role of the Philippines in supply bottlenecks, whether there are any insights there. But I think the other question that's attached to the same one, which is what are the long-term growth drivers? And as we heard Dwight talk about there, as the Philippines has a degree of resilience, could you perhaps give us a central bank view there as to the arguments as to how the Philippines navigates through, say, future policy adjustments, monetary policy adjustments around the world, and what its degree of resilience will be in growth drivers?
Thank you, Mark. So I think I was listening very closely to what Dwight has been discussing, and I think he he emphasized the really important points for us right now. We have built up reserves even before the crisis. We have invested in structural reforms, including fortifying policy frameworks, and that has helped build credibility, and that has served us in good stead during this external crisis. Even during the GFC, we have been noticing the positive impact from this effort. So I think the continuity of a commitment to structural reforms, to improve policies, to improve sectors will be very important moving forward. And on the part of the monetary policy, given the possibility of tightening conditions later on, aside from the gross international reserves, we have other foreign exchange flows that have proved resilient before, and those remittances and BPO revenues we think will play an important role moving forward. But over the longer term, there are concerns that the scarring effects of COVID could be a challenge in terms of going back to the potential output that the region, including our country, has experienced before. And here, the labor market is something that we would like to focus on. The national government is trying to ease restrictions soon so that people can go back to work, so that people can go back to the labor force. We will open up school and then try to face-to-face learning. I think those are very important points. And in terms of rebuilding or fortifying human capital. And the another point is the physical capital also. The government is committed to spending more than 5% of GDP on infrastructure. And we think that will also play an important role moving forward to limit any potential scarring effects from the pandemic. So I stop here, Mark. Thank you.
Thank you very much. We just have a few minutes to go, and with 5 on the panel, it doesn't leave a lot of room for points. But I might go back to the question I was going to ask originally, if I could. If each panelist could just give us a very brief insight into what scarring they'd like to see adjusted. I think the word scarring's been used, or what policies they think are going to be critical to the region to come together. And it's quite hard to ask this question. Could be a number of areas, or in fact, what areas we need to watch for. It might be supply bottlenecks, it might be trade, it might be fiscal adjustment. But if you were just going to pick something, and it's a bit unfair because the region, each country is different, but perhaps you could just in summary give us a sense for what to watch for and your sense of whether it's getting back on track, whether it's being adjusted. And I might just open by saying, of course, our number one thing is the virus itself, and that everybody's fit and well and safe. So I think we all know that's the number one. But just in terms of the economies, I'm asked Mr. Sumi first as to what you would like to see come out of this that we should focus on for growth in the region.
I think it's first and foremost is a human capital. That
Yes.
We have lost the schooling days, especially in the advanced economies, emerging market and developing economies. Whereas in the advanced economies, the availability of web-based education is widespread, but we can't say the same for the emerging market. So, and then also Asia, we have so huge young population, right? So these people need to be trained to fit this either AI and automation age. So the technical knowledge and then the training is critical. So the human capital, catching up with this lost schooling days are very important. And then I would say that as Zeno said, that the physical infrastructure, especially for renewable and to secure the electricity energy, is very important. We observe that premature disinvestment or non-investment into the fossil sector, while the renewables have not caught up yet. So we have seen the disruption in the electricity supply in China and then that elsewhere as well. So this, that smooth transition between this, and of course, the making it faster, the transition to the renewables, we need quite a lot of green investment. So these are, I think, two investments in the both human and the physical green investment. Thank you.
With that long list, I think we could summarize it by being good leadership as well, right? So that's a complex and long list. Margaret, what would you be looking for here?
Unfortunately, China doesn't have too much scaring effect. But going ahead, and given all the huge needs for renewable infrastructure investment, I think what will be important is productivity. What we have seen is that in the past decades, there has been a lot of unproductive investment, and also the incremental capital output ratio has worsened for many years. To avoid that, it's very important to plan proper investment and also to implement product market reforms that enhance competition in all the product markets. Thank you.
Thank you very much. Dwight?
Let me unmute myself. Yeah, I would actually, I would probably echo both of those comments, actually. I think one thing that stands out, it's a good thing for Asia, is that inflation has been very low over recent years. But inflation has probably been very low because the output gap in Asia is actually quite high. And so there's a lot of spare capacity in the economies of Asia, which is not always a very good thing. So it speaks a little bit to what both Sumi-san and also what Margit has spoken of now, which is ultimately productivity growth in the region needs to be picked up. And there is obviously ample spare capacity within regional markets, because had there not been spare capacity, we probably would have had a lot of inflation pressures. So there's a little bit of chicken and egg about all of this. But I think in order to try and generate growth through productivity growth, it comes back to continuation of infrastructure spending within the region. And actually, given the debt levels within the region, I think there is scope for many countries in the region to actually move towards higher infrastructure spending. The scope is there. And I think that would obviously be not a short term, but that would be a very long term project that would raise ultimate growth levels within the region.
Thanks very much. Dennis?
Thanks, Mark. I'd say probably the challenge in terms of the gradual withdrawal relating to fiscal and monetary accommodation. COVID-19, both short-term and near-term, of course, there are the current supply-side bottlenecks and the inflation-related consequences of it. Now, I mean, the majority of the inflation that we're seeing this year is transitory, so there's no disagreement on that whatsoever. But we continue to be of the view that there is a moderate structural component to it, which is longer term. So in terms of that balancing act between the longer term scarring, the economic in terms of real output levels, and the trade-off rather with inflation, which could remain somewhat higher for longer, managing that difficult balance is certainly a challenge for policymakers. I think that's easy to state as this COVID-19 crisis, in terms of exactly what happens to gradually recedes.
We might finish with the central bank view, since we're on FIF and so important to our policy discussions. And I guess you've touched on this already, really, but perhaps for the Philippines or for the region.
Thank you, Mark. So I also echo my co-panelists in identifying those very important factors in improving productivity as fiscal consolidation gets underway when the effects of the COVID slows down or dissipates. Then the quality of fiscal spending will be key. Spending on health, on education, on infrastructure will be key factors. And on the part of the central banks, it will be how to handle dialing down the policy accommodation, not too soon, but not also too late, so that you will be balancing financial stability risk, inflation risk, and supporting growth. And then finally, I think this is an opportunity for structural transformation of the economy, shifting to more digitalized economy, as well as a green recovery will be also important initiatives, important trust moving forward as we move post-pandemic. Thank you, Mark.
So I'd like to thank, we've run out of time, thank all of our panel today. And as everyone on the call would be aware, I don't think there's ever been a time where policy has not been more important as it was during the crisis last year. And it's funny, isn't it? It's in some ways we've become very good at dealing with crises because of the global financial crisis, and now more recently, the navigating part on the way out is really the art and the challenge. And I think we've heard an optimistic story about Asia, and it's very interesting, Dwight, making the point that the flows haven't been as strong as you would expect. But the region, I think, has learned a lot, going all the way back to 98, all the way back to dealing with crises. And the region, I think, has set itself up for what's going to be a very interesting period. And as I said at the very beginning, if Asia doesn't grow, the world doesn't grow, largely speaking. It's going to be very, very critical to get it right. So thanks to everyone for dialing in. We hope to do many more of these, of course. We do it on for all the time, but a focus on Asia, I think, is so critical for all of our colleagues around the world. And so I'd like to thank the panel very much today. And also just thank the panel for the great work that you all do at Scope, or at State Street does great work, but also the other government bodies. The research that gets put out today is absolutely A grade. And I think that is helping markets to be smoother, and is helping economies to recover, and is helping to create good policy debate as we try and navigate over the next couple of years to continue to grow for the benefit of the Asian region. So thanks very much for everyone tonight, and thanks for joining us at OMFIF. Thank you.